Did you know that some of the world's wealthiest investors seem to have a crystal ball? They get out right before the market crashes and then swoop in at the bottom. How do they do it? It's not magic, and it's not insider trading. It's a strategy, a pattern of 3 specific trades they make, and it's been the same for nearly a century. We're going to break down these 3 trades, look at how they played out in the crashes of 1929, 1987, and 2008, and then discuss what they might mean for the year 2025. Stay with me, because this could change the way you look at investing forever. Let's start with the first, and perhaps most crucial, trade: selling the hype. Think about the months leading up to a major crash. What do you see? Euphoria. Everyone is a stock market genius. Your neighbor, your barber, they're all giving you hot stock tips. This is what we call irrational exuberance. It's a market driven by emotion, not by fundamentals. The smart money, the billionaires, they see this. They don't get caught up in the party. Instead, they start quietly selling their most popular high-flying stocks. These are the darlings of the market, the ones everyone believes can only go up. Take 1929, for example. The roaring 20s were in full swing. Stocks like RCA were the tech giants of their day, soaring to unbelievable heights. But while the public was piling in, seasoned investors like Bernard Baruch were cashing out. They saw that the prices were completely disconnected from the actual value of the companies. They sold into the strength, letting the enthusiastic public buy their shares at the peak. They didn't try to time the exact top, but they systematically reduced their exposure as the frenzy grew louder. They sold the hype. This is a difficult move emotionally, because it feels like you're leaving money on the table. But discipline is key. Now, let's fast forward to the dot-com bubble in the late 90s, which culminated in the crash of 2000. It was the same story, just with different names. Instead of RCA, it was Pets.com and Webvan. Companies with no profits, sometimes not even a clear business plan, were reaching billion-dollar valuations. The public was obsessed. Billionaire investors like George Soros and Stanley Druckenmiller, however, were famously shorting tech stocks. They recognized the mania. They saw the same pattern as 1929, a disconnect from reality. They sold the hype, betting against the crowd, and we all know how that ended. When the bubble burst, they made fortunes while many retail investors lost everything. This brings us to our second trade, and it's a bit more subtle, shifting to boring assets. After selling the high flyers, where does all that cash go? It doesn't just sit in a checking account. The super rich move their capital into what most people would consider boring, safe haven assets. This is their defensive play. They are preserving their capital, preparing for the storm they see on the horizon. What are these assets? Historically, they fall into a few key categories. First up, high-quality government bonds, especially long-term U.S. Treasury bonds. In times of crisis, investors flock to the perceived safety of the U.S. government. So, as the stock market is teetering, these bonds tend to go up in value. This move serves a dual purpose. It protects their principal, and it can even generate a profit while the stock market is collapsing. Let's look at the 2008 financial crisis. In 2006 and 2007, the housing market was on fire, and complex financial products tied to mortgages were the hottest things on Wall Street. But what were investors like Warren Buffett doing? He wasn't buying subprime mortgage securities. Instead, his company, Berkshire Hathaway, was holding a mountain of cash and investing in solid, reliable businesses. And legendary hedge fund manager John Paulson, who famously bet against the housing market, also parked a significant portion of his firm's capital in safe assets while waiting for his big short to pay off. He shifted to boring. Another one of these boring assets is gold. Gold has been a store of value for thousands of years. It doesn't pay a dividend and its industrial uses are limited, but in times of fear and uncertainty, it shines. When people lose faith in paper currencies and the financial system, they turn to gold. We saw this in the 1970s during a period of high inflation and economic stagnation, and we saw it again leading up to and during the 2008 crisis. As banks were failing, the price of gold was climbing. The smart money wasn't buying flashy tech stocks. They were buying an ancient, yellow metal. The third category is simply cash and cash equivalents. Having a large pile of cash is not just a defensive move, it's an offensive one. This is the dry powder they're keeping ready for the opportunity of a lifetime. When everyone else is forced to sell in a panic, they are the ones with the cash to buy. This is how fortunes are truly made. As the saying goes, cash is trash during an inflationary boom, but cash is king during a crash. They understand this cycle perfectly. They sell the hype, shift to boring, and build a war chest of cash. So, let's recap the pattern so far. Trade number 1. Sell the overhyped popular stocks that everyone is talking about. Trade number 2. Rotate that capital into safe, boring assets like high-quality bonds, gold, and of course cash. This brings us to the third and final trade, the one that solidifies their legendary status, buying the blood in the streets. This phrase, often attributed to Baron Rothschild, means you should buy when there is maximum pessimism, when everyone is panicking and selling indiscriminately. After the crash happens, and the news is filled with doom and gloom, This is when the billionaires deploy their dry powder. They aren't trying to catch a falling knife on day one of the crash. They wait. They wait for the panic to peak, for capitulation, when it feels like the stock market will never recover. Think back to March of 2009. The S&P 500 had fallen by more than 50% from its peak. Lehman Brothers was gone. AIG was bailed out. The headlines were terrifying. The average investor was scared to even open their statements. This was the moment of maximum pessimism. And what was Warren Buffett doing? He was putting his money where his mouth was, investing billions into companies like Goldman Sachs and General Electric. He wasn't selling, he was buying with both hands. He was buying the blood in the streets. This is the hardest trade of all. Psychologically, it requires incredible courage and a long-term perspective. You are buying when every instinct and every news report is telling you to sell. But the billionaires have done their homework. They sold at the top, preserved their capital, and now they are buying world-class companies at fire sale prices. They know that, in the long run, the market recovers. By buying at the bottom, they set themselves up for massive gains in the next bull market. So, the three trades are a cycle: sell the hype, shift to boring, and buy the blood. We saw it in the 20s. We saw a version of it before the 1987 Black Monday crash, where hedge funds using portfolio insurance effectively sold into the rising market, and then the crash accelerated itself. We saw it in the dot-com bubble, and we saw it in 2008. The playbook is consistent. Now for the big question: what does this mean for 2025? Nobody has a crystal ball, and this is not financial advice, but we can look for the signs. Are we seeing hype? Look at certain sectors of the market, the meme stocks, the crypto frenzies. You could argue the sell the hype phase has been in progress for some investors. What about shift to boring? Have you noticed the recent attention on gold and government bonds? Some large funds have been increasing their allocations. And what about buying the blood? That part of the playbook hasn't been run yet, because the blood hasn't happened. So, what can we learn from this? You don't have to be a billionaire to think like one. First, be wary of euphoria. When everyone is sure the market can only go up, it's time to be cautious. Second, understand the value of diversification and holding some safe assets. Don't be 100% in the riskiest stocks all the time. Having some cash or bonds on the side isn't missing out. It's managing risk and creating opportunity. Finally, develop a plan. When the next downturn comes, and it will you be panic selling with the crowd? Or will you have a watch list of great companies you'd love to own at a 50% discount? The billionaire strategy isn't about predicting the future. It's about recognizing human psychology and market cycles. It's about discipline, patience, and courage. By understanding these three trades, you can better navigate the markets, protect your capital, and maybe even find the opportunity of a lifetime when everyone else is running for the exit. Thank you so much for watching. If you found this breakdown helpful, please hit that like button and subscribe for more content on smarter investing. Let me know in the comments which of the three trades you find the most difficult to execute. Stay safe, and see you in the next video.